Hi, ladies and gentlemen. Thank you so much for joining us today for our Fireside Chat. Today, we have none other than My Property Data CEO, Mr. Joe Hawk-Tor. Hi, Joe. How are you?
Hey, Ernest. Thanks for having me, man. Really appreciate it.
Excellent. I know that things are very busy on your side, and I wanted to thank you very much for taking this time out from your busy schedule to just say hi, and also to share with us your thoughts on our very interesting topic for today, which is, where do you think property market in 2021 will be? But before we go into 2021, how's 2020 been to you and your company?
How's 2020 been? Man, this is a funny question, isn't it? On the one hand, it has been an extremely challenging year. No mistake about it. We are part of the property ecosystem, and like everyone in the market, you do feel the effects. But on the other hand, this pandemic did have a bit of a silver lining for us. It did see an increase in demand for data, from property buyers to institutions like banks, to valuers, to developers and the like. I think what this pandemic actually showed was the importance of data. When you can't actually get out on the ground, you can't use your gut feel. When you actually have to substantiate things. And so that has been very positive. That has been good. It's really accelerated the adoption of data, more so by necessity than anything else. But it's a very positive thing. It's positive that people are looking at data more, that the industry is starting to look at data not just as a good to have, but something that is fundamental to the business.
Joe, I think for the benefit of our listeners, can you share a little bit about what My Property Data does? Because we're going to be dealing with a lot of data shortly.
Right. Okay. Sure. So My Property Data, we are basically a data provider. That's our core. So we like to think of ourselves as the largest online database in Malaysia. What we do is we collect all the transaction data in the market in Malaysia. We also collect rental data, demographic data, auction data, new development data. We send a lot of people out onto the streets. We scour the internet. We figure out what sort of pricing, how prices have changed throughout this period, what sort of incentives, rebates, and really what the buyers are looking for. That's the sort of thing that we do. We warehouse a lot of that, and from there we build solutions to help our users use this data. So if you are a bank looking to make decisions on the market, we give you all of that sort of data, what people are buying, when they're buying, are they still buying for that matter, how much are they paying, and how much, how's that translating into auctions? Do we see a lot of auction cases? What sort of discounts, what are the haircuts that you can expect? So that's a lot of what we do, quite similar for valuers. And we also do a lot of big data analytics work for developers and the like. So data and the use of data is, I suppose, the best way of putting what we do here at My Property Data.
Excellent. That's a very succinct way of putting it. And I know there's going to be a lot of number crunching on your end. But in the interest of time, where do you see 2020 ending before we get to 2021, which is what we want to focus on?
Where do I see 2020 ending? So give me a sec. I just need to pull my crystal ball out. It's
it's a bit cloudy.
It's a bit cloudy. I need to wipe it a little bit. I think 2020 is just one of those. I'm waiting for my money back on this crystal ball because the 2020 version isn't working as well. It didn't predict this new wave in COVID cases. I think we were all prepared. The industry was starting to feel a little bit of relief. I think there was a bit of bounce in everyone's step heading into this month, or the last month for that matter. That was from our observation. We were starting to see a lot of positivity. And then all of a sudden, in a blink of an eye, 2 weeks and things have changed. The numbers soared, and confidence, I suppose, has retreated. So where do we see 2020, you know, with this sort of volatility? I would say this is still going to be a buyer's market. You know, a buyer's market, not only because of economic forces, but also practical causes. You would need a very brave buyer to step foot to view properties or to buy. I think that there has been a lot of progress in the digital space, in the prop tech space, for people to buy sight unseen. But from what we can see is that a lot of it is still, a large chunk of it will still require buyers to actually show up at the showrooms. You know, there is still that emotional connection with property. It's something that is very hard to take away. So that, I believe, will still prevail. And because of that, I foresee 2020 to still be relatively challenging. But for those who dare, and those with the ammunition behind them, I think 2020 would be an amazing year, and for some parts of 2021, an amazing year to pick up some really good buys. This is probably the time to build up that property portfolio.
Great. And I think you echoed quite a lot of sentiment when I spoke to some of the other property players in town, the investors per se. So long as you actually have the firepower or ability to access firepower, i.e. capital, this would be an opportune time to pick up some choice properties that may not necessarily come out in the market or not come out at a price that, you know, could be palatable per se. But all in all, everybody also does believe that this is actually a buyer's market rather than a seller's market. And sellers who want to sell for top dollar, unless they have something really, really, really unique and really scarce, it's going to be challenging to actually ask for top dollar. Which then leads me to the next question. What happens to valuation per se for all those who have just taken their keys? Are they going to see a compression in valuation, or are they going to just see a stagnation in valuation for maybe 1 to 3 quarters out?
Well, so it's important to understand that valuation is just, you know, reflecting what the market is telling valuers, right? So it's important to understand that valuers interpret the market rather than create markets. So if valuers have reason to believe that there are whatever signals lower demand and decreasing price, then valuation of properties will follow suit. Now, in this current climate, we use the word, this is a buyer's market. The buyers hold all the cards. The buyers are the ones buying, and more often than not, that means discounts. Now, one transaction does not make a market. So if you get a really great deal on one property, where let's take, for example, the market price or the median price for this area is 500,000, and a buyer comes along and manages to pick up a property for 400,000. Now, that's 20% off the market price, and that's one transaction. And let's say that there are 10 other transactions in and around 500, within 5% or less of 500,000. Where would that market value sit? Based on that, it will probably still be closer to that 500. Now, if we're starting to see more transactions and a growing trend edging towards that 400 mark, that 20% or that 25% discount mark, or maybe 15% discount mark, then the valuer would have reason to say, okay, there is a chance that the market is trending downwards, right? And when we negotiate on property, how often have we negotiated, you know, when the asking price is 500? In most cases, buyers will go in and say 490, 495, 480, so on and so forth. What that tells us is that the value of property often sits within a band. There is a range in value. It's not fixed. It's not 9 ringgit 99 cents. Take it or leave it, right? Property isn't cash and carry. Well, to some people, it's cash and carry. But you know, there's always room for negotiation when it comes to property. And So what you'll probably see in this state is if the valuers think a market value, let's take the 500,000 property again, if the property is, the range is between 500 and 400, now that's a 20% range, it is pretty large. But if the valuer has reason to believe that the market is trending downwards, the valuer is most likely going to err closer to the 400, may not pick 400 because there's still transactions at the 500, but there's reason to believe that transactions are trending downwards, values are trending downwards. And so they'll err on that side of caution. Doesn't mean that the range has changed very much. The range is still there, but the value is likely going to err to the side of caution.
Oh, okay. I think that's a fantastic piece of news for all those who have bought or taken keys of late. I mean, I don't think that everybody will be selling en masse and all chasing the market downwards, because it will definitely also impact their wealth portfolio as well. Because even though you're not buying for investment purposes, and if you're buying to stay, you also don't want to stay in a situation whereby your property itself is actually a declining asset class as opposed to an increase or stable asset class. And property is being so illiquid, meaning that I agree with what Joe says, it is not cash and carry. It is something that has to be taken on with probably a considerable length of time for the debt and mortgage. You probably want to make the best decision possible for an asset this size.
Yes, and you're right, and I think one thing that just to bring comfort or a reality check of sorts, right? We hear a lot of commentary or analysis or news, saying that the market's going down, it's going down by X% and whatnot. I think it's always very important, if you're a property investor, to understand that you do not realize a loss unless you sell the property, right? Until you actually sell the property, you don't book in that loss. So it's all paper gains. It's all, all on paper. It's just a little bit like the stock market. You don't cash it until you actually sell it. So if there is no need to sell, if the market's going down, but you have a good tenant that is still willing to pay you the same level of rent, or maybe slightly discounted, and it doesn't cost you that much more, you're not in great financial strife, holding on to the property despite the negativity may be the best course of action for you, because you're not technically losing there. You still got the building, right?
Exactly. I mean, I still have stocks and shares that I bought since 1997. So there'll be situations in time when I'm like, yes, it finally is getting so close to where I came in at, and again, it goes up and down in tandem. But at the end of the day, this is not something that you buy and sell on a daily basis, and definitely this is not something that you buy and sell within every quarter. Ignoring for RPGT per se, properties are illiquid, generally by and large, and because they're illiquid, they have to be very, very carefully thought through. But what I think the central message that you're trying to say, Joe, and correct me if I'm incorrect over here, is that properties, despite the fact that this is a buyer's market, it is very bad for sellers, and buyers who have the capability of buying, properties still remain as an asset class that one can bang on to build their financial wealth. But it will take a long time, mid to long term period. It's not going to happen 1 year, 2 years. It may take slightly longer than that.
Exactly. Totally agree. And I think that's something that a lot of people need to understand, that it's very easy to get caught up in the emotion of it all. But one thing that we should always remember, and this is one thing that I love to reiterate, is that land is scarce, right? And there is a fundamental theory here. It's called Thunen's theory, the marketplace theory, where as population grows, as cities expand, demand for land will increase. And it's not as if you can move a city down the road, and suddenly render your piece of land worthless. It's not going to happen. Same reason that property is relatively illiquid. It's also very difficult to move. And so, as the city grows, as population grows, demand will naturally grow. So if you're sitting on the outskirts at the moment and the city center is 20 kilometers away, in 20 years' time, your 20 kilometers away will become part, it's possible to become part of the city limits as well. So, and when it is part of the city limits, then naturally prices would go up because there would be more demand. By how much? It's anyone's guess. That's akin to buying a crystal ball, but the fundamentals are there. population growth equals demand growth.
Well, I'm definitely not going to buy the crystal ball where you bought yours from, because that doesn't quite work. It's a bit wonky.
I've been trying out a few. Yeah.
Okay. But I completely agree with you when you say that, over time, things, the population growth and the expansion of the city limits will definitely encroach into areas which is probably going to be called semi-rural right now, and not so urban. So things will definitely change. But I wanted to just ask you, based on your data, if you can just share a little bit of insights. Is the movement of urbanization in the Klang Valley, let's not talk beyond Klang Valley for the moment, but within the Klang Valley, is it northward, southward, eastward, westward? I mean, if you were looking at getting involved and stepping onto the property ladder in itself, and you had only one bullet, basically, if you're looking to buy something within the 750,000 ringgit plus minus 20% range, would you be looking, which directions of growth or areas would you be looking at?
Looking at the map and how development has sort of grown, now I won't say one area is better than the other, but what we have seen is that there has been more development towards the southeast and to a certain extent southeast, southwest, slightly. That's probably a stretch. If I look at that, when we look at the map and see that sort of development, it does make a little bit of sense, because Seremban or Negeri Sembilan is also seeing development north, right? And northwest specifically, that's where Seremban is coming up. And so there seems to be a bit of a joining effect. It's not quite there yet, but in between, you do see a lot of economic drivers. You've got the airport. That's one. That's probably, if you're looking from the perspective of Klang Valley, that's probably more southwest than anything. But you've got the airport. You've got all these industrial parks around the airport, and these are all economic drivers, right? They are all sources of employment, and so it's I suppose in that sense, seeing the growth of the city in that direction does make sense. Now, we're also seeing growth north of the state, right? In the perspective of Klang Valley, we are seeing that, but it is at a much slower pace. Now, if I were to bet on something at the moment, I would say there is incredible value in the north of the city at the moment, the north of KL city specifically. Looking at the numbers, we're seeing, just on radius basis, right? Now, Malaysia is incredibly patchy. You might say, within 10-kilometer radius of the city, it should be this price, and 20 kilometers of the city, it should be that price. But it doesn't quite work that way in Malaysia. You get certain anomalies, you get certain areas which attract a lot of demand. Desa Park City is always the case in point. It sits in an area where the median price, it's almost double the median price of its surrounds. If you look at it purely based on the numbers, you think this is a bubble waiting to burst, but it is a bubble that just keeps getting bigger and bigger. And at some point, you got to think, maybe it's not quite a bubble anymore. Maybe it is the whole bottle full of soap. Maybe there is a lot of substance to this, right? So, and that's where it's very important to look at things on a very micro level. What drives the local economy? Some things on the face of it may not make sense, but there's certain nuances of an area which draws people in. And as long as those nuances remain, the attraction will continue. So to say where's development going and if we should target certain areas, I think it's also still very important to look at it on a micro level.
I remember catching a few Facebook posts recently with regard to a launch at Desa Park City. At this point in time and this juncture, I mean, the lines were evident. And but judging from the people who were waiting in line, I think they were very, very enthused that the price was the right price, as opposed to worrying that the median, it's twice as high as the median, and therefore there may be a chance for correction, but the demand is still very strong. Yeah.
Exactly. And what's very interesting about one of those developments is the one that recently launched as well, was that if you look at the median price, the median selling price, it actually shows a marginal increase on the median prices in Desa Park City for similar developments. And yet you see a queue, which indicates that demand clearly is outstripping supply in a place like Desa Park City.
Yeah, I think all the people behind the planning per se, by creating a product that meets with or exceeds consumer expectation, a product that improves their lifestyle and gives them a sense of value. I think those are the kind of developments that investors or people who want to buy even for their own stay would find their asset appreciating most or highest. And I encourage developers to actually do their due diligence first before building. And when they build such products that is actually on everybody's radar and they are interested enough, they will find a way to make it happen for them to purchase. It's only the challenge whereby when you overbuild or build something that's a little bit difficult to absorb in the market, and it really causes a lot of buyers or potential buyers to see all the challenges in purchasing one. And this challenges may then become the resistance factor that will say, no, I'll wait for something else to buy. It could be as simple as difficult to get a loan, or the loan valuation may be a bit of a challenge. Things as simple as that.
Yes, you're right. But actually, you brought up something really pertinent, right? And as you talked about, having that product that people really want to buy. That also lends very true to how buying a property is a very emotional thing. And when you're talking about emotional, you're also, it's a bit like, it's almost similar to buying a car, right? Cars evoke emotion. And more importantly, cars also evoke a sense of aspiration. If you are looking at a particular car, but it's outside of your price range, you would then start to look at that as where I want to get to in a period of time. And that all really just boils down to branding, isn't it? And we're starting to see that, the importance of branding. If you're able to brand it and build up that emotional connection, and more importantly, build up that aspirational perspective in buyers, you will see that longer term growth rates, right? Now, it's not very common in Malaysia. We don't see a lot of it. There are only a handful of developments that have done that really, really well in terms of building that brand name and building that aspiration. But I think it's something that hasn't been looked at enough. But at the same time, it's also we're also seeing, in our market where you've got all these aspirations. Aspirations is one thing, but making sure that people can afford to get it. It's a bit like ordering pizza from one of our, one of the major chains, right? They have this thing where they tell you your pizza is being baked, your pizza is now up for delivery, or it's like one of your food delivery apps, right? Because you are already part of that process, you feel invested in it. You feel less frustrated. You can see that your rider's on the way, or you can see that your pizza is already in the oven, and that sort of takes away this uncertainty, this in between, the black hole of where's my pizza? I put in that order, or I put in this food order. Where is it? And it's a bit the same with real estate, right? If you can make it achievable for someone to take that first step, to feel that they're invested and part in the process, and knowing that they are able to get to where they want to be, I think that's what's missing right now in Malaysia. I think we're seeing, the aspirational products are just so far up, nothing in the middle. That's just a perspective that and something that we've been observing quite a fair bit, in terms of numbers, because the numbers in terms of transactions are really, really large. Especially in the Klang Valley, the gap is big.
Yeah, and this is going to be an interesting thing that will continue to unravel well after our conversation here today. And I think that what's happened in 2020 is probably 5, 10 years out will just appear as a blimp. Oh, there was an anomaly, but that anomaly was due to something that was completely unpredicted. But having said that, the question then now is, if you had the capability, capacity, and if you actually had the interest, do you pull the trigger now, or do you say, let it stabilize and let it be on an uptrend first before I jump in? Joe, on a personal basis, and this is where your personal point of view comes in, if you qualified to borrow, if you were qualified to borrow, you had the financial capacity to, would you buy now or would you wait?
Provided the price is right. If I had the ammunition, if I had the financing ready to go, I would. But what I would probably do to hedge my bet at this point in time is I will probably look at something that is trending at a minimum 10% below the median rate, right? So if I'm looking at an area, I'll be looking for something that's going at a minimum 10% below the median. From there, I'll know that this is probably a good buy. The other thing is I'll then have to figure out, can my rental cover my repayments, right? And if my rental doesn't cover my repayments, how long before it comes up? How long before it reaches, so how much money do I have to prepare, right? So these are very important things that I would probably look for. At this point in time, there has to be a acceptance that rental rates are also going to fall. If prices fall, rental will fall. Okay, because we are in a market in Malaysia where there is a lot of supply, there are a lot of developments, and if investors or owners are unable to sell, they are going to rent it out, and there's going to be a lot of them, and high competition, they'll drop their prices, right? So an important aspect is to make sure that you have the firepower to hold on to your property and at least until rental rates recover. So that definitely has to factor in. So that could come from A, having more money in the bank just to write that out, or B, maybe looking for even bigger discounts that to counteract that.
Joe, would you be more partial to a primary market product or a sub-sale product?
I think there is a case for two products. I think that both of them serve a particular need. I believe a lot of the demand for primary markets is to do with the incentives, the rebates that the developers give, and this I strongly believe it is something that the developers are doing purely to address a fundamental need in the market, which is your down payment. Now, if you look at a ₹500,000 ringgit property, you put down 10%, that's 50,000 ringgit on top of the stamp duties, legal fees, etc. You're probably looking just under 100,000, in your upfront costs. Now that is a lot. I don't know very many people who walk around with 100,000 just lying around. I think with cost of living in Malaysia, and our wage rates, unless you every year you get really great bonuses. So it's difficult. It is a real challenge to come up with the down payment. And I think what developers do is offer all of this for free. So there's limited. You might be able to afford your monthly repayments, but you might not have the 80,000-90,000 upfront to buy a property. So if you fall into that category, and you're able to purchase, despite the rebates and incentives, purchase something that is below the median price, then I would say that is still a property worth buying. Because bear in mind, the moment the property is ready, new properties tend to attract better rental rates. But again, it is a scale, right? And as the property ages, the rate will decrease, which then you have to think about improving the property. Now, if you buy a sale property, you won't get that. So you will have to front the money up, right? You will have to pony up And more often than not, these are older properties, so you will have to think about renovation and that sort of thing. But the main thing by buying in the sub-sale market is you are probably buying in an area where you're able to easily quantify the market, right? The product is there, the prices have been there, you are better able to ascertain, is there a potential of this going up or not, right? Because you have trends, you can see what other people are selling their properties for over the years and that sort of thing. So that, I suppose, will give you a little bit more comfort. But that also means that you might be paying a little bit more of a premium when you're buying in, because you've got a lower risk attached to it, right, compared to buying new properties. But if you're buying primary, if it's in a great area, you know, I think fundamentally, as long as you do your research, there is a case for both.
Joe, I know that I'm moving away from some of the data stats and data points, but I'm sure that your decisions will also take that into account. I'm going to ask you something a little bit more personal. Can I just ask you a rapid 3-4 questions and then tell me what's the first thing that comes to your mind, yeah?
Sure. Ice cream.
Landed.
Sorry, you haven't asked.
Landed or strata?
Landed.
Freehold, leasehold?
Freehold.
High floor, low floor, mid floor?
Mid floor.
Lot of facilities or just more space?
More space.
Do you see dual key as a big advantage or not?
Yes.
Great. I mean, this is definitely something that I think a lot of people also aspire to. It's just a question of budgets. And it's also sometimes impossible to get freehold when almost everything in the area that you really like is all on leasehold. So sometimes it needs to be adjusted, I guess. But if we move beyond Klang Valley, can I just ask maybe your quick thoughts between JB and Penang? Do you see the turnarounds happening faster for which state? Can you tell? Would you like to share?
From what we're seeing, actually, bear with me as I just pull up some of these stats. What we're seeing in Penang is that transaction volume has actually fallen by nearly 10%, right? But in Johor, it has only fallen by about 3%. And median prices has actually stayed relatively stable at about 5% and Penang has fallen by about 10% as well. So this, to me, is a little bit indicative of the market, right? We talk about Johor a lot. Everyone talks about, you know, the overhang and all that sort of thing. And I think Johor really does get a bad rap in that sense. But if we discount, so the stats I quoted there, I discounted a lot of the developer sales. So I've only used actual transactions. So, you know, most of it will be sub-sale or some primary ones where the titles have been issued and whatnot. And if we look at that specifically, Johor actually has done fairly well or has kept its value to a certain extent, gone up slightly during this pandemic. And I think the reason for that is because Johor is like the poor bloke that has been beaten up for the last 2 years. So he's already on the ground. And there's only one way from there. Whereas Penang has been riding this wave, right? Penang has been, you know, been at the forefront for a lot of foreign investors, MM2H, Kota Kinabalu as well. But, you know, a lot of Hong Kong and Chinese investors do like the idea of Penang. Penang does hold a special place in a lot of Malaysians' hearts, so too does for the rest of the world. And so you're probably going to see prices still on the high side, the sort of people that buy in Penang. And don't forget, Penang has scarcity of land because it's an island. Then there is a big gap between the mainland and the island. I think a lot of developers are starting to try to change that. They're trying to shift, putting better product on the mainland. But by and large, when we think about Penang, we think about the island. And so, you know, it is going to be a tricky market there because you're going to get segments of the market that can afford, and that's probably going to prop that market up for some time to come. But you'll also get a fair bit of speculators because if these are areas with a lot of investors, especially in the island, then You'll also see people dumping if they can't afford. So it is going to be, I believe that there will be some fluctuations in Penang, where else in Johor, the poor guy has been on the ground. It's probably about time that he got up. And I think it is reflected in the stats that it hasn't been, as a state, hasn't been as affected by this pandemic.
Great. Thank you so much for your insights, Joe. And I know, ladies and gentlemen, that if you let Joe and I share our thoughts over maybe just a glass of warm water, let's not talk about anything else because it's before 4 p.m. Joe has a tremendous amount of data and insights based on data. So it's not gut feel. And one of the things that I'm most intrigued every time when I speak to Joe is that the insights offers very unique nuances in how we understand the market per se. And we're very thankful that he's actually given us some of his time today to actually share these insights, especially in this point in time when the numbers are slowly starting to creep up again. So ladies and gentlemen, still be very wary, be safe wherever you are. And last but not least, in this fireside chat where we actually aim to share any information, all information that will help you make better financial decisions, Joe has graciously said that he's got some interesting data sets to share with you if you're interested. Would that be right, Joe?
Yes.
Yeah.
I think the best is, drop us. There is so much data here in Malaysia, and there's so many insights that we can get. I think the best is to say, what is it you're looking for? And let's see how we can help you out.
Yeah. So ladies and gentlemen, all you want to, if you just want to have the insights sent over to you or shared with you or whenever they become available to be passed on to you, just comment me in the message box below and I'll collect the information. And then from that information, Joe and I will be able to share that information whenever Joe and My Property Data releases it. And whenever Joe and I have a chat, you'll be the first to know as well, so that you can also participate and ask the questions that are relevant to you, your portfolio, and also your financial future. Thanks again, ladies and gentlemen, for tuning in. Joe, any last thoughts before we call it a day?
Not really, but let's just hope these numbers goes down, right?
Absolutely.
It is scary.
These numbers, I definitely want to see going down for all our sakes.
Yeah.
Absolutely.
That's right.
So ladies and gentlemen, thank you again for tuning in this session of Fireside Chat, and we'll catch up with you soon. Thank you. Bye-bye.
Thanks.